Hello, this is Doug Gerlach, founder and editor-in-chief of the Small Cap Informer stock newsletter, and we're here with our 2022 mid-year update for subscribers. In today's webinar, we're going to be taking a look at the performance of the small cap and broader stock market so far in 2022. We'll update you on the performance of the newsletter halfway through this year and for longer periods. We'll also take a look at the economic cycle and how that's impacting investment decisions in the broader market. We'll give you an update on what's new on the Small Cap Informer website, as well as our top small caps list for 2022. And we'll have a little bit of time for some selected company updates. As always, feel free to chime in with any questions using the questions box and grab that handout. It's a PDF that's in the handouts tab in the GoToWebinar application. In the back office, Russell Malley and Sean Pulrang from our team are standing by to help you as well if you're having problems. And so we appreciate their participation in our webinar today. It is July 13th, 2022, so we're halfway through this 2022 year. And I'd like to take a moment just to recognize that our first edition of the Small Cap Informer was published in August of 2012. So next year, we officially celebrate our 10th anniversary as a publication. That is a pretty significant milestone. It gives us a decade's worth of performance figures, and hopefully we've improved along the way. Thank you to those of you who've been along with us since the beginning, or since very nearly the beginning. And we're looking forward to many more years of investing success in the future. Let's talk about the performance of small cap stocks so far in 2022. Here's a graph year to date of the major market segments that I like to track. The red is the EFA, the Europe Australasia Far East Index. This is a large cap international index. Started out the year strong, but has since sunk along with the rest of the market. The S&P 500 is in blue, and the S&P Small Cap 600 is in green. And these have been tracking very closely for the first 6 months of the year. That's pretty unusual, but I think that's indicative of broader trends in the global economy and global marketplace that investors throughout the world are looking at the performance of stocks and equities and comparing them to alternative investments, and really not seeing a lot of having as much interest in stocks as they did in the past. So we're seeing small caps and the S&P 500 and EFA all down about 20% year to date, and that should be no surprise to most of you. When you look at the first 6 months of 2022, it is one of the worst first half years ever for small cap stocks. If anything, perhaps that suggests that maybe the worst is over, and that once the excess has been shaken out of the market, a lot of investors might start to be interested in high quality, fundamentally sound small companies going forward. As is usual throughout the year, small caps have led the way downward, as they do when the broader market plummets. But if history is our guide, we would expect that small company stocks will lead the recovery as well when the market moves upward. When investors regain faith and confidence in American businesses, those small company stocks are going to be the beneficiary. And as a reminder, history suggests that when we experience challenging markets, that is the optimal time to be investing and to enter the market and to deploying capital if you are focused on the long term. If you're still a little nervous, still a little skittish, there's nothing wrong with dollar cost averaging or baby stepping into undervalued companies if you're not completely comfortable. But just remember that if you were completely comfortable, that would mean the market's performing well and you've missed your opportunity. So learn to overcome your personal biases and take advantage of the opportunities here. Yes, things could get worse, but we are also confident that the future will deliver much, much higher returns for equities over the next several years. A reminder that and here, let's just take a look at the broader the broader market as a reminder for the last 20 years, those same three segments, and that green line on top, the S&P Small Cap 600 outperformance compared to the S&P 500. That's why you're here. That's why we exist. We're trying to capture some of that excess return and mitigate some of that extra volatility that's so evident on this particular graph. The long-term nature of the market is always upward, so keep that in mind as you're making decisions about your investment portfolio. Now let's talk about the Small Cap Informer newsletter itself. Remember that our newsletter's objective is to outperform the S&P Small Cap 600 index. We see that as a better representation of small company stocks than the Russell 2000 index. Yes, much of the media looks at the Russell 2000 as a proxy for small cap stocks, but in our viewpoint, the selected 600 companies in the S&P Small Cap 600 index really are closer to our definition of what makes a small company stock than the companies in the Russell 2000. Our returns that we generate for the newsletter probably won't exceed the overall market. There will be times when it does, but over the longer term, that's not our objective. Our objective is to outperform the small cap segment of the market with our selections. And we believe that small company stock investing is just part and parcel of what you invest in as an individual investor. Diversifying your portfolio between small and large companies, and over time that will give your portfolio the optimal risk reward characteristics, allow you to capture the upside when small caps or large caps are outperforming, and then balance it out when either one of those segments tends to be underperforming. So keep in mind that our objective is not to be 100% invested in small company stocks, but to use the stock selections in our newsletter to augment your ordinary portfolio, which for many investors leans excessively towards large and mega cap stocks. So when we look at the numbers as of June 30th, 2022, our lifetime performance is 6.2% compared to a compound annual return on a benchmark basis of 0.4% for the S&P Small Cap 600. The 1 year, 3 year, and 5 year rates of return have also been very strong. We're very pleased with that 52-week performance there, significantly outperforming the small cap indexes in the last year, which is a very difficult period for investors. So we're pleased with this record, and as we had hoped when we started the newsletter, our longer term objectives are intact, and the fact that we're able to outperform over the longer term periods we see as a real advantage to the service and the value add of the newsletter. So with that in place, feel free to share your questions as we go. We're going to talk now about the economic cycle and the stock markets and how they interact. I see a lot of misinformation, a lot of headlines about what's going on in the economy. Certainly everyone's talking about inflation. Interest rates are going up. Later this month, the Fed is going to be meeting again. And there's another increase of perhaps 75 basis points built into expectations for the rates at this point. Housing sales and mortgage applications seem to be cooling off, so that's concerns some market watchers. But on the other hand, unemployment is falling. There are new jobs that are being created. Housing rentals are beginning to stabilize because there was a building boom in 2020 and 2021. So we've got a lot of new units coming to market, and that's going to ease up some of that housing crunch and probably pull down the average rents, which have been a little excessive for a lot of individuals, and kind of counteracting some of the inflation in housing costs. Commodity prices and freight rates are falling. They're falling pretty significantly. Since the start of the year, commodities across a wide range of precious metals and agricultural inputs have all been coming down. Freight rates from China have fallen significantly as well, 30 to 40% in some cases. So that is also good news for the supply chain There are mixed signals as always. So what does this mean for investors and for consumers? Well, when we look at the University of Michigan's Consumer Sentiment Survey, this measures consumer confidence. On this graph, you'll notice the light gray shaded areas. These are the recessions that we've experienced since the late 1970s. And you can see that regular measurement of consumer confidence, consumer sentiment, going high, going low, falling prior to recessions, falling during recessions, then recovering. And so at the far right here, you can see that we're below that 60 level. So it's low, but it's been a lot worse in 2011, 2009, going back in the 1980s. It's kind of surprising how low the consumer confidence didn't fall in 2020. Surely it took a big drop from 100 down to below 75, but that was still much higher than consumer confidence was coming out of the 2008, 2009 financial market meltdown, bear market, and recession. But when when consumers are uncertain, when they don't know what's going on, when there are mixed signals they're hearing, that leads to a drop off in that sort of consumer uncertainty. But I think if we take a look at and try to understand some of the basics of the economic cycle, how it works, where we are, what's the outlook from here, I think it can go a long way towards assuaging some of those fears that investors and consumers have about what's going on in the broader economy and how it impacts their wallets at home. Economists measure the health and the general trend of the economy in 4 phases based on the gross domestic product of the United States and or other key indicators. There are, in fact, a number of different ways that you can define recession, define when a peak or when a trough has been reached. But the basic principles are going to be very similar depending on the economist. So the economy goes through 4 stages, starting with expansion, that's the growing phase of the economy. The peak, that's when the growth has reached its pinnacle. Then we go through a contraction or recession, and at some point that recession ends at the trough, and then we go back into the expansion phase. And if you think about the expansion phase, first of all, this is when manufacturing is going strong, companies are hiring workers, there's demand for goods and services across the board, and so businesses are trying to serve that need. Employment is near or very close to what we would consider full. We've got people who are sort of optional from the workplace, who don't need to work but choose to work, coming into the workplace because there are a lot of opportunities, wages are going up. And so with all of this business activity going on, costs tend to rise. It's more expensive to pay your workers, for instance, and so we have this trickle down effect from there. So costs are going up, but the standard of living is going up. So even though things are slightly more expensive, you're getting paid more, so you don't feel the pinch in your wallet. During the periods of expansion, this is when companies are investing in capital projects, they're expanding, they're building new facilities, they're trying to accommodate what they perceive to be future needs, as well as the present needs of their business. They're taking on projects that require a lot of capital because they have excess cash flow. And this is considered the normal state of the economy. And over the last several decades, on a federal level, the interest rates have been managed to not let this expansion phase get too hot, but yet keep it going in that growth mode. So expansion phase is what we're kind of used to. At some point, however, what we see is the economy reaches a peak, the point when, if you think of it in terms of supply and demand, goods and services are matched up. The market for goods and services are saturated. Companies may have been optimistic. They made a lot of stuff that now they can't can't sell all of it, so at this point, companies really can't keep growing. They've got to retrench. So the economy reaches that peak level, and we go into the contraction phase, the shrinking phase, which is also known as the recession. When the demand declines for goods and services, then businesses are going to pull back on the manufacturing. And when they're pulling back on the amount of stuff that they're making, goods that they're selling, services they're providing, they're going to lay off workers. And when you lay off workers, that means individuals have less to spend, and so their demand for goods and services also decreases. When people have less to spend, they downsize, they shift from eating out several times a week to only a few times a week. They shop at stores that perceive to provide greater value instead of looking at brand names. So there's a whole impact on the economy of this phase. From the company's perspective, they're now postponing capital investments because they have a less clear future ahead of them, perhaps. They might continue on that downsizing throughout the recession, trying to balance out the need for future growth with the current needs of the business. Peter Lynch, in one of his books, wrote about this recession as being really critical for companies because in the long term, by forcing companies to become more efficient during a recession, they become stronger. And when the recession ends, those companies are going to be able to resume their growth phase with in a much better position. They'll be well positioned to take advantage of future opportunities. So recessions are not the end of the world, but they are something that get bandied about in headlines on a fairly regular basis. During a recession, cyclical companies, those companies that are highly subject or sensitive to the economic cycles, will typically lose money, or they'll see profits decline during this phase. So they'll see their growth slowing, they'll see their earnings falling. Often you'll see, when you look at these cyclical companies, revenues continue at the prior growth rate, but it's just harder to make money. They're not able to capture as much market share. So during a recession, this is a great time to be for your defensive holdings, your healthcare, your utilities, your consumer defensive companies to be in your portfolio, the ones that are going to perform well during all periods. They're going to hold true during recessions, during contractions. The consumer defensive companies include grocery stores, drug stores, discount stores, because they don't see large sell-offs. They don't see customers staying away as much during a recession. On the other hand, anything that has to do with disposable income tends to be impacted. Traditionally, people don't travel as much during a recession. People don't buy cars as much during a recession. So we want to make sure that your portfolio is balanced out between defensive and cyclical sectors in order to capture maximum benefits. At some point, companies cut to the bone. At some point, things have been right-sized, if you will, supplies reduced, so there's no excess demand, and businesses can start to ramp up their growth. When that demand starts to return, they need to start hiring, and so we go back into that expansion phase, and hopefully the companies are going to be in a better shape after that. And that cycle just continues and continues and continues, and each peak hopefully reaches a new high over time. This economic pattern has been going on since economists, really the science of the economy really began, and economists have been able to go back and reconstruct, for instance, the American economy going into the 1700s. And obviously, the economy was very different in the 1700s, in the 1800s, in the 1900s than it is in this modern world that we live in today. But that's those are the common cycles. And what we don't see in a graph like this, it looks like everything is kind of equal: the expansion, the recession, the trough, that it appears with regularity. And that's not really the case. We'll take a look at that in a minute. The question, where are we now? Well, we don't know. And that's another interesting topic. But somewhere in this area, we are very close to the peak on one side or the other. There are a lot of economists who think that the recession has started, so we're already in that recession phase. Well, how come we don't know? How come someone can't tell us that we're in a recession? All we're talking about is the chance of a recession. Well, let's talk about and understand how a recession is identified. The National Bureau of Economic Research, NBER, is the organization that regularly reviews economic indicators. They do it quarterly, they do it monthly, and they define a recession as a significant decline in economic activity across the economy lasting more than a few months. But in doing that, they consider three criteria: uh, depth, diffusion, and duration. Depth is how bad is the recession, or what is the impact? How much of a sales slowdown or manufacturing slowdown? Unemployment, how much are we seeing? Diffusion, how widespread is it? Is it impacting the entire country, just portions of the country? Is it impacting all types of businesses? And then duration, how long is it? And interestingly, the MBER declared a very short recession in 2020 when the pandemic started. It was not a long recession, only a couple of months, but it was very deep, and it affected every business across the U.S. to one impact, one factor or another. But typically you'll see all of these. So they balance it out, they figure it out, and it's only after a recession has started that the MBER can actually recognize that it started, right? Because it takes, if you're gonna define a recession as a period in which these factors happen, this expansion is underway, you've got to wait to make sure that it's actually happening, and that you don't see a false start, for instance, although they will address that in their documentation as well. And likewise, on the determining the end of the recession. So in some quarters, or in some academic environments, the recession has been defined as a drop off in GDP. More often today, there is much more data available. If you look at the Federal Reserve's, the FRED website, it's the Federal Reserve's data site from the Bank of St. Louis. They have several thousand different economic data series that you can graph and chart over time, really looking at all sorts of indicators, including adjusted versions of those indicators. But some of the key factors that people look at is that the economists look at: real personal income, non-farm payroll employment, separating from what's going on in the agricultural industry, employment, real personal consumption expenditures, that's a big one today, the PCE, wholesale retail sales, industrial production. And when you look at this, you can see that, get a little bit of a sense of what is considered when the MBER is looking at those key indicators. As I mentioned, when recession ends, they've got to wait until the recession has proven itself to be over before they announce the end date. There's no particular number of months that's required. So right now, I've seen headlines in the last few days that say, a survey of academic economists shows the majority of them believe we are already in a recession, right? And so I think a lot of individuals would say, yeah, it feels like we're in a recession, but there's a hitch, because we also have rising prices, and that doesn't fit with the definition of a recession. I think one of the observations that we need to make when we look at recession data across time is that since the Great Depression, back in the 1920s, 1930s, the economy in the US has shifted significantly. Used to be primarily manufacturing and agricultural, till today we are much more focused on services and technology. Uh, Another factor is globalization that allows businesses to keep their costs in check, although there is a risk to that, as we've seen in the last few years with tariffs, supply chain issues. But when you're able to cross borders and manufacture parts and components and goods where it's more economically feasible to do so, it helps companies to maintain their own costs and serve their customers and make a profit. When you talk about manufacturing that does exist, we see huge shifts in how manufacturing is undertaken with systems like just-in-time delivery. That's a great example where companies now don't sit on warehouses of components and parts that they need to make an end product. Instead, they have arrangements so that when they need widgets, they call the widget maker, who sends over a truck in 72 hours, and those widgets go right off the truck onto the assembly line. They're not sitting in a warehouse somewhere. So the advantage of that for companies is that when we suddenly hit a recession, they're not sitting on parts that are obsolete, parts that they can't use, components, materials that are very quickly depreciating in value because they're not being used for their intended purposes. Another closely related to that is, as you can imagine, since the 50s and 60s, there's been an enormous upswing in data collection. If you are a manager of a manufacturing business or a services business for that matter, you have much more information available, what's going on out in the field, how many products are being sold. You can see trends immediately for goods that are sold in stores because that information is coming back to you. If you think about 40 or 50 years ago, you might have sold a lot of stuff, went out into the retail marketplace, then it didn't sell, and then it came back to you weeks or months later, and you realized that you messed up. Today, that is much less likely to happen, and so that's helped to streamline what's going on in the greater economy in the US. And when you put all these factors together and other shifts, cultural shifts, you see some significant changes in the duration of recessions, primarily since the 1980s. Here's a graph from the 1920s through the early 1980s. The gray areas are the recessions. The white areas are the expansions. So we've got recession trough, expansion peak. And then that cycle just continues, and continues. The brownish line there is the S&P 500. So you can actually kind of catch that in many, but not nearly all of the recessions, the market declines. In some recessions, the market doesn't recline. So we've got this disconnect between the market and the economy in many cases. But what you'll see, especially in that 1940s to 1960s period, is a sense of regularity, where we've got a regular expansion, then a recession, then an expansion, then a recession. And, the lengths are pretty long. In the 1960s, we had a long economic expansion in the US, driven by technological advances like Polaroid and Xerox and the space race and all of the adjunct technologies that were developed for launching man into space. So we had a year that was known in the stock market as the go-go years. So good, strong, long expansion phase. But of course, all good things have to come to end. In the 1970s, you may recall the energy crisis and the OPEC oil embargo and the impact that it had on the economy. So we had an extended recession there, and then we get into the 1980s. And now let's look what happened from the 1980s through the 2022. And you'll notice that there are many fewer recessions. The expansions tend to be much, much longer. We had a record expansion in the 2000s. We had, or in the 1990s rather, coinciding with the dot-com boom. We had another record expansion from 2009 through to 2020 when the pandemic started. We had that short recession in 2020. So you can see that recessions have been occurring much less frequently. When they happen, they don't last very long, and yet we have a whole segment of the media and a lot of investment advisors who go on television, talk about the risks of recessions and what that's going to do to the broader American business and how that will impact your investments and why you should be terrified of all of the recessions. Again, from my perspective, recessions are recessions are part and parcel of the course of business. Throughout the years, there have been moves to suggest that perhaps we might not ever have another recession. In the 1990s, there was talk of a soft landing to the economy. Everyone saw the economy was heating up, but they thought that the Fed could manage it with interest rates, and there would be perhaps no recession in the future. And of course, that hasn't happened, and I don't expect that that would really happen at any point going forward. So my takeaway is we're not afraid of recessions. We have a diversified portfolio as investors. I hope that I certainly would hope that you would have a diversified portfolio, and that we can sit through economic slowdowns, confident that they will end, they won't be very long, and they will continue in the future. And yes, it's possible that we might have a longer recession. That 2009, 2010 recession was going to be the Great Recession that would last as long as the Great Depression, and it was nowhere near that long. So the interesting thing is that when we start talking about inflation fears, understanding what's the connection between inflation and recession. Well, usually inflation, which is defined as the general increase in costs of goods and services, inflation declines in recessions. There's lower demand, there's reduced economic activity, costs tend to go down during recessions, or at least not increase. And yeah, if companies are making less stuff, if they don't have a lot of capacity, if they're running lean, or if they have high levels of inventory, that can hold back price increases. If they've got inventory that they need to get rid of, they're going to sell it at discounted rates. So we don't really see inflation during recessions. Key factors, a couple of key things that we typically see that will hold back inflation. Companies that when they have excess inventory, they're more likely to discount prices. If unemployment goes up, then wages are going to decline. If you can't find workers, you've got to pay more, so wages go up. If there's lower demand for raw materials, commodities prices are going to fall because they can't find buyers. If there's lower consumer confidence, which we're seeing now, people are going to be reducing their spending because they're worried about future costs going up, or they're experiencing the inflation right now. Houses are going to fall in price, as well as other assets, especially luxury goods. Again, if there's reduced demand and lower prices, the wealthy expenditures and other spending is not going to increase over time. So we see during recessions, it's uncommon that we would see prices growing significantly. There's a lot of talk as well in the last few years about inflation being transient or permanent. Transient meaning transitory meaning temporary. And there are, of course, people out there talking about how inflation is this time might not be transient, but might be permanent. But historically, inflation is always transient. It just might take different amounts of time for prices to revert to long-term trends. And if you look at graphs of the rate of inflation over time, yeah, you will see periods where for several years, instead of a 2% annual gain, it might be 2.5% or 3%. But then at some point, prices normalize, and then we might see inflation running at 1.75, 1.85, 1.9% for a number of years, right? So it vacillates around that long-term trend. I think most economists don't really expect inflation to keep keep on going. Yes, the report came out yesterday or today. Inflation is higher than had been expected, and again, I would expect to see, I'm not calling the a peak on the rate of inflation. It might go a little bit higher, but I certainly don't expect it to continue to grow and increase. The market and businesses always find a way to navigate through. So I don't think inflation is a significant midterm to long-term concern. In the short term, people will adjust as they always do. The the Federal Reserve Board, says that 2% inflation is its target, although they don't, they say they're fine with variability around that rate. If inflation is too high, then the Fed might raise the federal funds rate to bring inflation down, right? So you increase interest rates, make borrowing more expensive, and that will keep some companies from making investments that might cause the cost of goods and services to go up. And likewise, if inflation is too low, then the Fed will reduce the interest rate, which we've seen in the last decade, to help keep costs going. Right now, the question is that the Fed is saying, yeah, we're going to raise rates, but inflation is rising. And that puts us in a unique situation that we haven't seen very often at all. And that brings more headlines about stagflation, which is rising inflation with falling economic output and declines in employment. But stagflation isn't something that's systematic, that happens with any sense of regularity. It's often caused by a sudden jolt to the economy, such as the rise in prices of commodities, or more commonly of energy, because those costs come so quickly that employers really have to immediately cut production, lay off workers. It might happen in an industry or sector setting where a particular raw material price becomes significantly higher. When this happens, consumers are struggling to get by on reduced wages, and yet prices are going up. If there are labor unions that are very powerful, that can keep wages high in the face of rising costs, that can also lead to stagflation or significant shocks to the supply chain. But again, those tend not to last very long at all, and that those stagflation is managed on a policy level by with a lot of uncertainty. The policymakers really struggle because if they increase the rates, they're going to reduce inflation, but cutting rates will help reduce unemployment. And so those periods of stagflation are quite rare and usually short-lived. So my interpretation is the Fed is signaling they're going to raise rates. And so that to me says that on a policy level right now, inflation is not that big of a concern. So I'm not worried. Yes, we've been navigating the last 2 years with supply chain issues, cost of goods, cost of raw materials, and freight costs, et cetera. I think a lot of those have normalized, and so I'm not especially concerned right now. It is, I think, more telling when we look at the core inflation rate, when we talk about the last time inflation regularly exceeded 3% was in the 1980s. Yes, we had much higher inflation at the end of the 70s going into the early 80s, but since 1990, the inflation rate has generally been below 3%. And since about 1991, all the way through to 2022. So this just means that we've got 40 years where young economists have never dealt with the active scenario of inflation kicking up to that 4%, 5% level. And consumers are worried, understandably, if costs of the stuff that they buy is increasing. Yes, they have good reason to be. They've never experienced this before. And the people who have experienced high inflation back in the 80s today barely remember it. because it was so long ago. So I think that this is contributing to the levels of uncertainty. But my position at this point is I think we're going to be okay. And I think that we're going to start to see inflation drop off by the end of the year as businesses normalize, as they do. Businesses adjust, and well-run businesses will always find a way to continue their operations to make their businesses stronger. So this is just a little take on the economy and the market. To recap, recessions and bear markets don't always go hand in hand, but if you understand the cycle and some of these pressures and can see beyond the headlines a little bit, I think that will benefit you. If we experience a recession, which I think is pretty likely to be short in duration. The average in the last 50 years, the average recession is something like 10 months, 14 months, 15 months. So it would be fairly brief. And then we're back to standard operating procedures. And there's nothing in the inflation outlook, there's nothing in the other economic indicators that would give me pause. We are in a bear market, and bear markets are opportunities for long-term investors. And so my fundamental belief is unshaken in that regard. All right, so questions. Yeah, Bob Ritchie says, do we trust the inflation numbers since they measure inflation differently since 1980? Yeah, this graph that I showed you is primarily since 1980, and it is, let me flip back to it real quick. This is the trimmed mean personal consumption expenditure inflation rate. So yes, this is sort of a modern adjusted inflation rate that I think is much more relevant than some of the other measures. This is an aspect of the science of economics that the economy has been shifting, as I mentioned. So what do we measure and how do we compare it against? And things that we measure today, ratios and indicators that we measure today, don't really mesh with a measurement in 1950s when the country was making automobiles and heavy machinery and steel and aluminum, and today we do much less of that. So it's a good point, but this particular graph accommodates that particular concern. Tim asks, what about the war in Ukraine? How does that impact the price of food and oil, and the overall impact on inflation? Certainly, what's going on with Russia and the Ukraine has not had a significant impact um, on energy costs in the United States. There are other factors at play, but some European countries, especially Germany, are going to continue to struggle with energy costs because of not being able to have access to that Russian oil that they become accustomed to. So we've been actually pretty oil independent in the U.S. for the last couple of decades. I think it points to the need for continued work in the U.S. to keep us as energy independent as possible, to keep finding alternative sources of energy, developing those sources, continuing to invest in solar and wind and tidal generation, et cetera, over the long term. In the short term, we have other concerns. Yes, Ukraine is a major exporter of wheat. So again, there we've got an issue, but here in the US, it's not as likely to impact us since Canada is also a major producer and we do a good deal in the States. So I think we've been fairly well insulated here in the States so far from the economic impact, but we might start feeling it with some of the companies that do business with companies in Europe or operations in Europe. I would expect to see a little bit more there. Yeah, Tim says, I've read that, let me hold on a second. That semiconductor inventories are growing and have perhaps exceeded demand. What does this say for investment in semiconductor stocks? And this is an interesting question because semiconductors are typically an example of a business that runs on its own economic cycles. Yes, they respond to what's going on in the greater economic cycles, but they have their own cyclicality because of the costs of tooling up a plant to support building a next generation of chips and everything that goes into it, and then you produce that chip for a period of time. It might be a couple of years before that chip becomes obsolete. So now you've got to shut off the factory, retool it to make the next generation. So the chip that you made 2 years ago is now selling for a third of the price at which you started making it, but you made back your investment. But now you've got to keep going, right? And so we've had a couple of interesting things happen. One is the crash of cryptocurrency has had a negative impact on semiconductor chips, especially with respect to graphic cards, which are integral to Bitcoin and cryptocurrency mining. And so, yes, that's leaving those companies with excess inventory because they were ratcheting up to support the demand for cryptocurrency, which has really kind of crashed. And so it's not profitable now to do Bitcoin mining, not as profitable, we'll say, to do Bitcoin mining as it was last year. So they're, you know, they're hoisted on their own petard, you could say. They have brought this on themselves in large part, serving this market. So um, um, uh, I think when we look at the chip-related companies in the small cap informer universe, yeah, we see the next 6 months may not be as rosy as we might hope, but again, we look out longer and would expect some recovery for many of those companies in 2023. And at this point, they're deeply discounted because of those broader concerns. All right, let me jump on and we'll talk about some of the improvements we've made to the SmallCap Informer website. We have a couple of new features that we've released in the last couple of weeks. We have a brand new subscribers homepage. We have a new closed position report, and we have a new in this issue online summary. And the subscriber homepage, this is what you get to when you log into the website. Before, we would give you the list of the current issues and the archived issues, and you'd have access in a menu bar to all the other features. Now we're presenting it on one page that brings in the highlights from all these different content areas and calculations that we're making. So you still got access to the current issue right there. It's one click away. Your expiration date and renewal link are there as well. We show you the recent blog posts so you can keep up to date with news and events that might be related to the small cap informer and small company stock investing. We have been calculating the biggest gainers and decliners since the last issue, and we also calculated every night based on the prior closing day. So you can see what are the big movers from day to day or from issue to issue, what are the big decliners. Recent message board posts, we have a full featured calendar that includes dividend dates, estimated earnings reporting dates for all the companies we cover, recent technical changes, and a link to our full technicals report. We have the roughly monthly update on newsletter performance, the small cap market update, so comparing the S&P 500 to the S&P small cap 600, and links to other web features that we have. So when you log in now, you'll see something that looks like this: lists of the recent issues, alerts, events, biggest gainers and decliners. And again, it's interesting when you just the 5 companies from a couple of days ago: Clearfield, new pick. Very pleased with that, up 26.9% since the last issue. LGI Homes, Century Communities, Cavco. So the next 3 companies there, all the home builders that we're, again, bullish on over the long term. We acknowledge in the short term there could be some headwinds there. But those 3 stocks were the next 4 biggest gainers. And then Winnebago, again, a consumer cyclical RV manufacturer, showing big price gains. So I like being able to see that and kind of see some trends, and gives you a good sense of what the market is doing. The market one day just over a short period just said, oh, we thought all the home builders were going to be shut down by now, and turns out they're still building homes and making money. So it seems pretty self-evident. On the right, the expiration date, recent blog posts, headlines, the recent technical changes. So the idea is that it will ping when companies cross the 50-day or 200-day moving average up or down. The full technicals report gives you the relative strength in the money flow indicator as well, and what that signal is, what that trend is. If you scroll down the page, you will see the decliners, the upcoming events, the message boards on the right, the overall performance of the newsletter, and the performance of the small cap market in the bottom left, linked to some of the other subscriber tools. Richard says, what stocks did you use in the small cap informer to determine your rate of return to the index? So the rate of return includes all stocks in the newsletter purchased in equal amounts on the day after publication date. And we measure the compound annual return, we calculate all the dividends, and then we benchmark that against similar purchases and sales of the small cap 600 index. So because we're not a portfolio, we don't have a recommended portfolio, we are a research service, this is how we calculate the overall return of all of the securities, the stocks that go up and the stocks that go down, and as if you were holding them all in a portfolio and didn't take any action other than to buy them when we recommended them and sell them if we recommended a sale. The closed position report is a sortable report of all the stocks that we've covered in the past and discontinued. So we have the buy and the sell dates and the gain loss percentages and the dividends that were attributed to those securities. We don't include, the rationale for sale, if it was bought out, if it was sold for valuation, sold for fundamental weakness, but the date of the sell issue is included so that you could look it up if you wanted to. So simple report, but again, just trying to be transparent. There are a bunch of winners, there are a bunch of losers. We tend to hold the winners though, so this report of closed positions is mostly the picks that didn't work out quite so well. But there are other companies where we did initiate positions and closed out at a profit as we saw the future having less potential perhaps than we expected, or the valuations were high. So that is, again, you can peruse that if you want to. Sometimes you will see a company, for instance, with a number that indicates we lots essentially. So we recommended it. Universal Display, we recommended it in March of 2014 and January of 2015. We closed out both those positions of March of 2017. So you'll see number 1 and 2 separating those different recommendations. So that's there if you're interested. And finally, the issue summary is only available going forward, so starting with the last issue going forward. It's the start page for the issue. It really it's the one page, too long, didn't read the whole issue if you want to know kind of the basic premises of it. So it's got a little 1-paragraph summary of the editor's comments, tells you if there were any sales in the issue, and then it gives you a 1-paragraph update about the 2 focus stocks. Meant to be a quick read summary, so you can grab that instead of downloading the whole issue if you really just want to see what the company is, what the sectors are, industries, what are the recommendations there. This is only available online. It's not in the print or the PDF issue, but you'll access this page whenever you drop in to download the new issue. All right, so let's talk now about the top small cap stocks for 2022 website that we that we took a look that we produced back in January. We've been doing this for the last couple of years. We selected 10 stocks from our coverage list. We broke it out as in this year with 5 top stocks and 5 deep value stocks, recognizing that we had some stocks that were not fitting our growth profile as much as stocks that appeared to be excessively undervalued. So we pulled those into a separate list. The focus is still on long-term performance, but we measure them, at 6 months and a year. Occasionally I go back and look at the 2021 or 2020 top small cap stocks. I figure we'll do that in a few years. We'll go back and take a look at some of those original recommendations. But in the 5 top stocks for 2022, as you would imagine, they on average are down 18.4% along with the rest of the market, but that is less than the S&P Small Cap 600 on average, which is down 19.3%. Intermex is big winner, up 28.3% year to date. Glacier Bancorp down 15%. LCI Industries, Universal Display, and Skyworks, all in those a little more economically sensitive or cyclical industry groups, are down, even though prospects for those companies, I think, are all very strong. So very satisfied with that. We're outpacing the S&P Small Cap 600 and the broader market with those picks, even though they are down. Our deep value growth stock list, we've since closed out one of these companies, but yeah, they continue to be underappreciated by the market. Afia, the Brazilian company, is being held back by, in part, results are being held back because the Brazilian real is one of the best performing currencies in the last 6, 12, 18 months. So their business there is going very well, but again, difficult for American investors. Corsair Gaming still working through supply chain issues, but hopefully those will resolve. As I mentioned, educational development had that final quarter that didn't show the progress that we wanted to see based on pre-pandemic levels of sales and earnings, so they were discontinued. Gravity, again, Korean company, so I think remains a deep value pick. And my longtime favorite, Superior Group, and again, we're waiting for that comparison to pre-pandemic levels, but everything that they have reported in the last several quarters compared to where they were in 2019 has just been phenomenal. So I think the future is still bright for this particular company. It's the least worst performing on the deep value list, but all in all, these are the smaller companies still remain for the most aggressive portion of your portfolio. We'll update those stocks rather, when we take a look at and we'll take a closer look at their performance throughout the year at our year-end webinar probably in January of 2023. All right, so I wanted to leave you with some selected company updates and conversation. These are companies I think you might want to take a second look at. They're companies I like. They all begin with the letter I. That's in part intentional. 2 of my favorite stocks right now are Innovative Industrial Properties and Intermex. Yet InMode had a phenomenal day yesterday where they pre-announced their quarterly results and saw their price jump up today 15%. And Installed Building Products also has been performing quite well and rated, been gathering more and more attention. So I just wanted to talk about these. I think they represent some interesting ideas and concepts given what we know about the economy and the market. Installed Building Products is been growing by acquisition. They closed on another acquisition earlier this year that's going to deliver some additional earnings growth. Analysts still looking at very strong returns through the year. Yes, if construction slows down on homes and commercial buildings, this company could see its performance affected. But There's no sense yet about when that might happen, how severe that decline might be, and right now you can buy a company with, at a P of 20 that's got a pretty good long-term growth trajectory in place, uh, and the price lower than it was throughout all of calendar 2021, even though growth has still been strong. So I like it. Zacks recently rated them one of their number one or number two outlook stocks. So I think that bodes well for the near term for the business. InMode is um, has, as I said, reported preliminary results. Revenues were up much higher than analysts expected, so it saw a nice uptick in its stock price. PE is 13. The price still remains very low relative to its history. We have ratcheted back our growth rate to very low levels relative to their history. InMode makes products for medical purposes to support non-invasive cosmetic surgery. And they're expanding their market into the obstetrics gynecological practices. They're expanding globally. Their business is shifting a little bit from product sales to recurring revenue from materials that are needed in the procedures that the equipment supports. So the bear case for InMode is that during a recession, cosmetic procedures get pushed off. So again, investors are working on the foregone conclusion that we're going to have a recession and it's going to last a long time and it's going to cause InMode to go near bankruptcy. And so it's already priced at that level. Even after the price jump yesterday, the stock I think is still pretty attractive for long-term hold as long as you can weather the intermediate ups and downs. I think it really is a deep. I saw a newspaper article commentator who said who referred to InMode as a deep value stock. It's a growth company, but it's selling at deep valuations. And Innovative Industrial Properties is a pick from our last issue. This is the real estate investment trust. It's a triple net lease structured real estate investment trust REIT. They own properties for the cannabis industry, the regulated cannabis industry in the US, including, so for uses as grow houses. But essentially what they do is they build the facility, then they lease it to the cannabis businesses, and the cannabis businesses pay for all the upkeep, all the taxes, everything for the duration of the lease. And so once the building's been built, then Innovative just collects the lease. So there's a risk, of course, that the cannabis industry is going to go up in smoke. I don't think that's going to happen. The cannabis industry across the country is becoming, when you think about medical cannabis, that is being accepted on a statewide level throughout the United States, and really by 2025, all 50 states are going to permit medical marijuana. So I think that's pretty much a given. We can discuss the pace of it. We can debate if some of the states are going to be more recalcitrant. Yeah, we expect that, but all in all, medical marijuana is a fact. It's happening. And recreational marijuana legalization is not far behind in a regulated industry. So this is the business that they're in. They're serving it well. The growth is there. The companies that are operating, have the capital needs. They can't get capital in traditional ways. So these sorts of arrangements to lease the facilities work to everybody's benefit. If you don't like the company, you might like the yield at 6% right now. So sit around, capture the yield. Growth is going to deliver some capital appreciation, and I just think it's an interesting business to be in. Anecdotally, here in Connecticut, where I live, marijuana was recreational marijuana was legalized. Medical marijuana is just had the first 16 licenses extended across the state like this week. So movement is happening, change is happening in the industry. And so from a business perspective, I think it's pretty strong. They got beaten down by some short sellers earlier in the year. They've also issued more shares that causes some dilution, but this is how REITs raise property. They do this all the time. It's not, they need capital. Issuing shares is a smart way to do it. So I think the business is really interesting. I wouldn't touch most other businesses in this particular area, but I just think the physical real estate has significant value, and the operation of this business could be quite profitable for investors. Intermex is another one of my favorites. International Money Express, known as Intermex, the money transfer company, large operations in Latin and South America, Central America, but expanding in Africa and other parts of the world, also in southwestern US, a lot of money, remittances going from immigrants in the US back to South America, but in South America, they serve as a proxy for banks, where in communities where most of the individuals don't have bank accounts, this is how they can have access to digital currency to pay bills. Their agents are set up to accept bills, to offer debit cards, to refill digital apps. So just a really interesting business here in the US. We don't know hardly anything about the money transfer business and how people exist in a cash-based economy in other parts of the world. So there's plenty of growth here. They're a disruptor. They're a user of technology. They've been a good performer this year. So the price is a little bit high, but I still think it's one to keep an eye on and potentially dip your toe into as we go forward. So a couple of quick questions before we go. Bob says, what do you think of shadow stats? I don't know it, but I'll take a look. Richard said, should we hold DHI, LGI, CS, CCS? Yeah, everything in the current issue is a hold, at least a hold or a buy at this point. You mentioned LGI Homes and Central Communities, CCS. These are the home builders. We have been fans of those companies for a long time. And they have been big winners for us. They're down in price, obviously, this year, but Century Communities selling at a PE of 5 or 6, emblematic of what happens when in the housing industry, which is notoriously cyclical. Housing starts boom and bust. We still think that both those companies focus on entry-level homes, and there's still unserved, unmet demand for entry-level homes in the United States. Cavco is likewise in that industry. We like those companies better than companies that might serve a broader market or serve higher-end homes. But we still see the demographics supporting the flight from urban areas into the suburbs, into communities. We see existing home sales of existing homes dropping off. And that's good news for new homes, because oftentimes people make that trade-off. Do you buy an older home and make repairs to it, or do you buy a new home? So all other things being equal, we think a lot of people would choose to buy a new home. The other thing that's going for those companies is they're very strategic about where they operate. So they're looking at areas where the economy is booming, where there is big demand for housing, and there are parts of the country where it is very difficult to find housing. So they're continuing to serve those areas. Yeah, we would expect to see a little bit of slowdown. We might see some slow quarters, but they have been performing so well when raw material costs and supply chain issues and labor issues were at the forefront. As some of those ease up, we would expect them to continue to be able to maintain operational efficiency and keep their margins going for for the long term. So we and the Investor Advisory Service, our companion newsletter, also um, in the face of a pending recession, was saying, yes, some of these housing stocks look interesting. So we're not shying away from it. The recession, if and when it comes, is not going to last forever. So if you've got the wherewithal to buy a stock that is trading at such a low PE ratio and just sit on it for a couple of years, those could be exceptional opportunities. That's my take on it right now. Bob says, do you think our economy could be like Japan and the S&P goes flat and does not climb for a significant period of time? No, I don't think that's very likely. I think what happened to the Japanese economy in the 80s, 90s, 2000s is not at all something that we would expect to see in the U.S. The 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 people who claim, I mentioned stagflation because the prospects of stagflation happening, in my view, are very small, and yet you see people worrying about it. So I think our economy has been resilient and will continue to be resilient, and we'll continue to see lots of opportunities. And by focusing on individual companies, you can go where your comfort zone is, where you uh, those companies that you might be a little uncertain about. Yeah, you can hold back on those. Kevin asks about InMode, that my upside downside is over 10 to 1, and projected total return is over 25%, and relative value is under 75%. He says, what do you take from those judgments? Well, this is what I wrote about in our most recent commentary, that we've got a lot of companies that have very high upside downside ratios right now. We have very high projected total returns, and that's what happens when you've got so many stocks that are near or close to their 52-week lows. It's not about the company's operations at that point. If 40 of the 50 stocks that we covered are trading within 20% of their 52-week lows, this is not a failure of our philosophy. This is not a failure of our analysis skills. This is the market saying, we just don't like small company stocks. We just don't like stocks at all. And they've beaten it down. So I take it as a measure of broader market acceptance and perspective, rather than on the specific judgment on any of the particular companies that we follow. Yeah, we're not right all the time with our analysis, but right now I think it really is a buyer's banquet that we can take advantage of, and be patient and be rewarded for our heroic behavior by buying when so many of these stocks are priced so advantageously. With that, thank you so much for turning out, for being a subscriber. We'll look forward to seeing you at the start of 2023 at our next regularly scheduled webinar, or at other events across the country. We're working on an internal calendar tool that will help us let you know what my travel schedule is, where I'll be presenting virtually as well as in person around the country. So hopefully that will give you opportunities to continue to ask questions and interact with me as you continue on your personal investing journey. Our presentation archives will be updated later this week. So if you wanted to catch it on replay for subscribers, probably in a couple of days, it'll be published on the SmallCap Informer website. And then in a month or so, we usually release it on our YouTube channel in an edited format for non-subscribers. But thanks again. We appreciate it. Thanks, Russell and Sean in the back office. And we'll look forward to seeing you at our next SmallCap Informer subscriber event.